Dr. Doom says to brace for a crash. That combines the worst of the financial crisis and 1970s style stagflation. Investors' famous last words, "This time is different." They say it in the context of, "This time the bull market will just go up forever." However, we already are in a bear market. This time is obviously way different than the 2020 crash, because 2020 crash was a liquidity crisis. This time is worse than a liquidity crisis. A liquidity crisis is short-term and deflationary in nature. It can be solved by QE and direct deposit stimulus checks. That's why after 4 weeks of crashing, we were right back into a full-blown bull market. This time, the root of the problem is inflation. The Fed lied to us, the people, about inflation last year. Now they are raising rates, attempting to force a recession. They are trying to force the unemployment rate to rise, forcing countless hardworking Americans out of a job to fix the problem that they caused in the first place. I said it before, this time the stock market will crash like in 2008. But it's totally different in a fundamental way. What's the differences between this time and 2008 and 1970s crash? And why it will be worse than both of the eras. I will explain it right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these markets, you are intelligent. That's why you're here. And you know what to do, and push my button. If you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to support all my work. If you want to be my good boy, apply to write your first book with me, author of best-selling books, Goddess Cheryl. My good boys always obey and they always get rewarded handsomely. Have you been a good boy? You will get the encouragement you need on your author journey. Even Amazon's billionaire founder Jeff Bezos has warned the U.S. economy is headed for a recession and recommended Americans brace for a painful downturn. The Fed has hiked interest rates from virtually zero in March to 3.25% today and signaled they could approach 5% next year. Higher rates encourage consumers to save rather than to spend or invest and make borrowing more expensive, so they typically reduce aggregate demand and relieve upward pressure on prices. Bezos is well placed to comment on the U.S. economy, given Amazon is one of the country's biggest employers. With 1.5 million workers, Amazon has been cutting costs, slowing spending, and freezing hiring in recent months, suggesting it's expecting a tougher economic backdrop. Recession fears have grown in recent months because the Federal Reserve is actively trying to cool the U.S. economy. The Fed's goal is to bring down inflation, which surged to a 40-year high of 9.1% in June and remained above 8% in September. The first difference between now and 1970s is that U.S. have $31 trillion in debt. Second, unemployment rate in 1970s is 9% versus 3.5% now. Like I said, this time is different than 2008 financial crisis in a 1970s way. There is no high inflation pressure in 2008. 10-year yield is about the same right now at 4.1% as the peak of 2008. Then the market crashed. The yield crashed with it to about 2% for 10-year yield. The CPI in August of 2008 was peaked at 5.6%, then it started going down. By November, it has already down to 3.7% because of the oil price tanked to $30 a barrel, dragged down by the stock market crash caused by the Lehman Brothers collapse, and it froze up the capital markets. Business and consumers couldn't get loans, so it's a corporate crisis. Yes, you had the Fed intervention to bail out the AIG. This time we have a red-hot inflation problem that caused by the Fed and the government stimulus plus the negative supply shock, meaning we don't have enough refining capacity for the oil we need. That's why oil price hasn't come down yet. In a typical crash like 2008, bond yield will go down because everyone will run into the bond market. However, we are facing a systematic solvent debt risk in the financial system, misallocation of capital on a central bank level crisis, which is what we have in UK. The pound had fallen to a record low in response and triggered a destabilizing rout in the government bonds. That's why Liz Truss resigns as UK Prime Minister after 44 days taking power. We are in the uncharted waters, the level even the Fed can't print their way out of this time. In 2008 financial crisis, the Fed had to loan $20 trillion to the European banks. We just destroyed $40 trillion in US capital markets today. If the Fed wants to print their way out of this coming systematic crisis, they have to print hundreds of trillion dollars. If you think we have an inflation problem now, it is going to be hyperinflation if they decide to print. Just like Dr. Strange said to Tony Stark, we are in the end game now. Dr. Doom, Nouriel Roubini, says to brace for a crash that combines the worst of the financial crisis and the 1970s style stagflation. The global economy will experience a period of decline that combines the worst aspects of the 2008 financial crisis and the 1970s. The Dr. Doom economist said Wednesday that he expects red-hot inflation to lead to a recession before major cracks start to appear in financial markets. It's going to get ugly. The recession, and you'll have a financial crisis. Roubini sees supply side shocks, including the world crisis and the war in Ukraine, as drivers of global stagflation, which refers to a combination of soaring prices and sluggish growth. That would echo the economic pain of the 1970s, when efforts to tame high inflation plunged the US into a deep recession. Inflation is not going to fall fast enough because you have the negative supply shock. Remember, when you have negative supply shock, you get a recession and high inflation. We are not going to get a fall in inflation that's rapid enough to go to 2%. But Roubini also compared the current outlook to the 2008 crisis, when the bankruptcy of Lehman Brothers and other financial institutions led a major market crash. European bank Credit Suisse is one major bank under significant pressure in 2022. With its shares plummeting over 50% as investors fret about the bank's liquidity. This is just the beginning of that pain. Roubini said, wait until it's real pain. And then you have a major financial institution that may crack globally. Not in the US maybe now, but certainly internationally. There are a couple of firms that are huge and systematic. They can go under. You might have another Lehman effect. The Federal Reserve will have to ease its aggressive tightening campaign if markets start to crack in a similar manner to 2008. While that pivot might bring some short-term cheer for stocks, Dr. Doom believes it could lead to inflation becoming entrenched at a point where a severe recession will have already become inevitable. The Fed will have to wimp out. You'll have a severe recession and you'll have a financial market shock. I don't believe central banks, when they say we're going to fight inflation at any cost, because they have a delusion of either a soft landing or a hard landing that is short and shallow. 2 quarters of negative growth and then you return to growth and easing. That's not going to happen. Okay, now I'm going to show my client Tina Kadish's 7 Steps to Thrive in Life and Business. This is called Freedom. And my client Teddy Eazzy's Wicked Pussy Perfume book, and it is an erotic novel. And my book, Lightning and Thunder, Discover Who You Are. I'm going to actually ask you, who do you think this is in this one right here? If you can guess, leave in the comment section below. And my book, Magic Mindset. All amazing books. So I hope that you've enjoyed my video today. I thank you for being a fan and supporting me. Bye.